Cheers, folks. What's going on? It's Kenneth, streamhomeloan.com and 100 Years of Wealth. Thanks for tapping in. Gonna jump into this video right away for you, but before we get started, just go ahead and like and subscribe. I would greatly appreciate that so we can continue to grow this channel little by little. But thanks for tapping in. So this video, as you can see, buy your first investment property with zero down. Buy your first investment property with zero down. So anyone that knows anything about mortgage financing might already be asking the question like, why or how can you do that? It's not allowed. You're not allowed to buy an investment property with zero down. And they're 100% right. With investment properties, you are required to put down, in most scenarios, it's going to be at least 25%. That's going to be for conventional financing. Fannie Mae, Freddie Mac, they're going to require you to put down at least 25%. There have been programs that I've seen where it's investor geared programs like DSCR programs where it's debt service coverage ratio, where they're using just the rental income to cover or as a qualifying number for income. But on those programs I have seen in the past where they got really aggressive and allow people to put down as little as 15% at one time. I feel like I haven't really seen that since the market kind of shifted in the last year and a half, but those programs have been out there where you could put down a little bit less than the traditional 25% on an investment property, and if they are still available out there, then obviously those are something to take advantage of as well. But traditionally, you're going to have to put down about 25% when you are buying an investment property. The obvious reasons are because it's a riskier transaction if someone's not living in the property. That person is, the lender is not qualifying a potential renter, they're just qualifying you to own this property and hoping that if you did run into a situation where your renter wasn't paying rent, that you'd be able to afford it. But they require you to put more down, and the rates are higher and the costs are higher associated with investment properties, because the likelihood is that if things got really tight for you, or the investor, whoever's owning the investment property, and let's say you're having an issue with your tenant, you're more likely to let the payments on that lapse compared to, let's say, your primary residence, right? Like an investment property, you might end up saying, and this isn't like, let's say, you particularly are like the average individual, but in tough times and in times where things are getting stressful, income's not as stable, that's where you see people willing to walk away from properties. And the reality of it is that you're more likely to walk away from a property you're not living in. So that's the reason why investment properties or investment financing is always going to require a larger down payment, have higher interest rates and higher costs than a primary residence. So to answer your question, or to answer the question, how do you buy an investment property with zero down? The reality of it is that there's only really one way to do it, and that's by living in the property first, right? So if you buy a property with conventional or FHA and you plan on living in the property for at least a year, you can find loan options that allow you to put down zero, right? Like as little as zero down, or put down nothing. The way, and we've done videos on this, but the way you would do it is that with conventional, if your income is under a certain number, if your income is under what's considered the average median income for your area, then conventional will finance up to 97% of the purchase price of a home for you, right? So conventional, let's just go right here, 97%, right? So in that scenario, if you qualify for that program that allows you to finance up to 97% of the purchase price, that means you can go after a down payment assistance program that covers the remaining 3%, and that would finance 100% of the purchase price of the property. With FHA, they will go up to 96.5%, and then you'll need to go find 3.5% down payment assistance, right? Okay, so primary residence, plan to live in the property for at least 1 year. Use conventional or FHA to finance the maximum that they will allow you. With conventional, it's going to be income restricted, where they will allow you to go up to 97%. If you're going conventional and you're not going to meet their income requirements, then they're going to cap you at 95%, right? And then you would have to, find down payment assistance. And the problem is if you're at 95%, there's not really down payment assistance programs that I see that cover 5%, right? You might be able to find another 3%. You'll come out of your pocket with a little bit. Not a big deal, but we're talking about 100% financing here. So if you don't qualify for the income, if your income's too high to fall under this bracket where you can only put the 3% down with conventional, then FHA doesn't have an income restriction on qualifying for their 96.5%. And then you go the route of just finding that other 3.5% in the down payment program or down payment assistance. I'm personally working with lenders right now that will do that particular program as low as a 580 FICO score. Okay, so most of the time, like I said, I currently have a lender that will do down payment assistance 100%. All the way up to 100% at a 580 credit. Come on, marker. Okay. So it's available if you want it. You just obviously have to be able to document your income because FHA, conventional, they do full documentation loans. Okay. So, and there you go. So the rule for them is they want you to at least be in that property for a year as your primary residence before you would decide to rent out the property. A year happens very quickly, right? So that's how I bought my first investment property. We stayed in the property much longer than a year. We actually planned on being there for a while, but then an opportunity presented itself to, grab another property where a little bit more maybe where we wanted to be. And we jumped on the opportunity and turned our first home that we got with an FHA loan into a rental property. And we kept that property as a rental, made a little bit of money on the spread between the mortgage payment and the amount of rent that we were getting on a monthly basis, and it was a good investment. Obviously, rental properties come with their own set of headaches. We had multiple plumbing issues throughout the time frame that our renters were there, and I don't know if it was we were doing something right or they were doing something wrong, but we started having some different plumbing issues that cost us some money. But overall, during that, let's say 2.5 year period where we had renters in there, they were paying the mortgage down for us, giving us a little bit of extra cash flow on a monthly basis. And then during that time frame, our value increased significantly to where when we sold the property, we were able to make some money. So it turned out to be a really good investment. If you wanted to go the route of like conventional, and FHA will allow you to purchase a 4-unit property, right? So you can go with residential financing, you can go from 1 to 4 units. Anything above that's considered commercial. So if you really want to maximize and really want to, kind of have an investment property even while you're living there as your primary residence, buy a multi-unit property, right? So I don't know how good this is coming across in the video, but this is a representation of a 1-unit property, right? So this is a single family residence, 1 unit, maybe a townhome or a condo if you want it. But you could purchase those with this type of financing, and you're in that property, and then you can decide later on when you want to move out, rent it out to one person. Or you can go the route of buying a 4-unit property, and you have unit 1, 2, 3. The owner lives in the 4th unit, obviously whatever one that they would want to. And when you qualify for your mortgage up front, you're actually able to use the rental income that the property is currently generating to help qualify for your loan. So if you're getting $1,000 there, $1,000 there, $1,000 at all the units, you have an additional $3,000 on top of whatever income you're already using from your employment source. All right, so at that point, if you were to buy that property, you already have an investment property, even though it is technically your primary residence. It's a great setup. After that year is up, if you really wanted to say, hey, you know what, I don't want to live the apartment lifestyle anymore, I want to move out of this unit, I'm going to rent out this 4th unit, and then I'm going to go and buy a single family residence. You could do that. So the main thing is that with FHA and conventional, the rule is they want you in the property for at least a year. At least a year, and you've abided by the rules, and you've maximized the ability to buy a primary residence with minimal down, You follow the rules by staying in there for a year, and then afterwards you made a smart move or made a move that made sense for yourself, rented out your unit. Now you have your first investment property. And you can do this again. There isn't some rule that says you can only do this 1 time, 2 times, 3 times. You can do it over and over again. I think, and this is something that I'm actually checking up on right now, but I think FHA may limit the amount of FHA loans you can have at one time, right? So you may, if you were planning on using FHA again, depending on how many active FHA loans you have, you may have to refinance one of them or refinance out of them to take advantage of FHA financing on a new primary residence, right? So that's pretty much it. That's the game plan. It's not really a big secret. FHA is very flexible as far as financing. Conventional is pretty flexible too. Most conventional lenders will allow you to go down to a 620 credit score. FHA is going to allow you to go down as low as 500, but if you want to be able to qualify for the 96.5% financing, you're going to have at least 580. Anything below that, they're going to max you out at 90% loan to value. Okay. So yeah, buy yourself a single family residence or a multi-unit property, live in one unit for at least a year. And then after that, you can turn this one unit into a rental, or you can actually rent out that 4th unit in your 4-plex. Or, you know, same thing. I've had customers where, I'm thinking of one customer right now where this is a couple years ago, but him and his wife bought a duplex. One of the units was already being rented out when they moved in. They moved into the other unit in the duplex, stayed there for I think 2 years, and then they ended up moving out of state, but they rented out the property. So during that time, they renovated it, brought it up to a higher standard, made it to where they can get an increased amount of rent on that particular unit, rented it out and moved. And now the property is just sitting there paying itself off and growing equity likely. And you know, turns out to be a good decision. But yeah, if you have any questions, feel free to send me a message or put something in the comments. And you know, like and subscribe. I hope you take advantage of this if you are interested in starting to build your investment portfolio. Yeah, thank you guys. Have a good day.